Amin Reina here from Sage Investors, and this is take number 26. Today, just before I get into my main take for today, I just wanted to do a little bit of a follow-up from my previous take where I was kind of talking down a little bit on the whole analyst community, the whole market prognosticators, and how they've been consistently wrong in their forecasts and predictions and prognostications. Since I did that little drop, from the previous take, a couple of interesting charts have popped up that I wanted to share with you to kind of reinforce that whole narrative that I was talking about. One was posted by The Economist, and it's called the Harry the Harry chart, and essentially it's a graph showing the interest rate, the actual moves in interest rates, and then off of that, the analysts, economists, predictors, their forecasts of where interest rates were going at those particular points in time. And what you can see is there is such a divergence from what actually happened to what all the analysts were predicting was going to happen. And it just further reinforces the fact that we just ask that question all the time is why do we continuously listen to these people? Second one is actually a chart that I pulled off that I show in my course, my everyday investing course, specifically the behavioral investing module. It's in the similar spirit, but it focuses on earning estimates on the S&P 500. And you can see the actual earnings EPS of the S&P 500 for each year, and then you could see what the analyst estimates were for those particular years. And as you can see, they're way off. They're not. It's not even close. And again, it's just further reinforces this narrative about the inaccuracies of trying to predict where the markets are going to go and the foolishness of it. Just don't go there. But people got to sell copies, people got to do clicks, and that's what it is. So I just thought I'd share that with you um, on that side of it. So today is, in a way, a little bit of a building upon that kind of the narrative I was talking about, just trying to add to it, bringing it into some real-time situations that I think investors are facing, and actually it's real-time situations that I am been personally facing. And I thought I'd share with you because I thought it'd be a good learning point. So building on this take about analysts being kind of way off in their estimates, over the last year, if you go back a year, it was being drilled into our brains that, a recession is coming, interest rates are going to come down as soon as humanly possible because of it. And, we've talked about how completely way off that has been. The economies are, global economies, especially US economy, is more than holding its own. Interest rates have not fallen, although the markets are pounding the table that they're going to start falling quite rapidly. The central banks are pretty much holding the line saying, nah, not so much. Uh, so what's been that impact of that narrative that has been infused into a lot of investors' brains is that we've seen a lot of investors sitting out. And what has happened while those prognostications have occurred, the markets have done extremely well. The S&P 500, NASDAQ, they're all like record highs again. You know, it's quite possible now because investors have missed the boat on this again because of these wonderful predictions going wrong that I could see a lot of investors starting to get a case of the FOMOs, the case of that fear of missing out, the case of that, the markets are going great. I'm sitting here holding the back bag doing nothing. I need to do something. And I think that vibe is out there again. And we're kind of in that really tense, very sensitive kind of stage right now where investors might be getting kind of nudged to get back into the market or nudged to kind of push all their chips in and go hardcore on the Magnificent Seven. And I'll be honest with you, and I've been getting a little bit of feelings of the FOMO too. Bringing it to where I'm facing right now, if I look at my portfolios right now, and I've commented on this, if regular people who have been following me and like reading up on my stuff, know that I've been skewing a lot more towards fixed income over the last year, and I've benefited from it in terms of high yields and a little bit of capital return. I still have exposure to stocks. It's not like I don't own stocks. I own stocks. I own I think a decent cross section, but not so much in the technology space. Last year, I was heavy into the technology. If you remember 2022, when tech stocks were just blowing up, I was going in and I was buying stuff. And last year, I benefited, in the early part of last year, I benefited from one of those FAANG stocks when I bought them in the depths of 2022. So I'm in the market, but I'm not necessarily right now in the places that are getting a lot of love. I'm in heavily into the banks, luxury retail. I'm starting to build up a space, some commodities. So this year I have no exposure to the Magnificent Seven. I have no exposure to FANG. And so when you're seeing these stocks kind of going up and up and up, when you're seeing Nvidia just keep going and going and going, you're going, do I really want to? Maybe I should just tag a little bit here with that little jet stream that's going on right now, that tailwind that's going on around these stocks. And it's really at these moments where you're getting that FOMO, where you're feeling like you're not following the groupthink bias that is out there. This is the point where you could start making some decisions that really could do some damage to your savings. And so the question is, how do you deal with it? Obviously, I have a course and I teach all this stuff and how to deal with this stuff. But I just want to share with you how I'm currently dealing with it right now. And really, the first thing you got to do, and the first thing I've been doing when I've been getting this, urges to want to just kind of dip my toe into some of these, hot and high flying kind of stocks, is go back to my playbook. Go back to my playbook and literally read my playbook and recommit and reinforce those core investing ideologies that I believe in. And for me, my investing ideology is about investing in wealth creating companies, can create tangible wealth, strong returns on capital, and buy them when they're cheap. So when I take that ideology that I have and I layer it and towards apply it to some of these companies, it comes out that they're not cheap. So, and I step back, and that's reinforcing my ideology, reinforcing my playbook. It's hard, and it's really, unfortunately, it is an occupational hazard with investing. And that is sometimes making decisions to take action or not take action that could be resulting in missing out on other opportunities. We are wired to want to be on the winning team. We're not wired. We don't want to be on losing teams. We don't want to be on the uncool club. We want to be on the winning side. And it's human nature. It's just that's how we are wired. But with investing, following that groupthink mentality, chasing the high flyers, unfortunately can lead you into the ditch and can lead you off your investing path. And ultimately, to be successful, from what I see from people who are really good at this, the people who are really successful at this long term, successful in the long term, it requires being successful in the long term, requires taking some pain, and it requires some being patient, and it requires a bit of discipline. And so one of the key things that you got to focus on right now, and key things I'm focusing on, is just making sure that I am still aligned with my playbook and I'm still aligned with my investing ideology. And because that investing ideology is consistent with my value system, consistent with how I believe I'm going to create wealth, and it's my investing path, and it's going to lead me to the path to where I want to be. So right now, as I said, I have a lot of exposure to bonds and fixed income. And, the mindset right now, the central banks have been consistent saying, interest rates are going to fall, but they're not only going to fall like maybe a few times. Wall Street, Bay Street, they're all like 7, 8 times like kind of thing. The reality is you don't fight the Fed. If the Fed has said they're going to cut rates a couple of times this year, that's probably what's going to happen. And so the market, again, back to the prognostications, may be out of water. And this is where you kind of have to dial out that noise, because if the reality is bonds might tread water and might not do a heck of a lot for me this year if rates stay kind of sticky. But the fact of the matter is, based on my ideology, based on my educated guess that I'm taking on this, and based on what the messaging that is coming from the central banks who ultimately make these decisions, at some point, and again, no idea when, I'm not in the prediction game, the chances are of the next move in interest rates is probably going to be downward. And whenever that happens, following my ideology, hopefully I'm going to benefit from it with my fixed income exposure. Because ultimately, if rates fall down, bond prices go up. So I might not get yield, but there's opportunities there to get equity-like returns, owning bonds, owning fixed income at a lower risk profile. And that aligns with my ideology. We saw a preview of this. If you look back in December when this all started, when the Fed was saying, you know what, we might be done with interest rates, we're going to start thinking about lowering interest rates. We saw bond yields fell, bond prices popped, and they popped pretty nicely. And so if we get a material shift, once we get that shift, ultimately to a falling interest rate environment, that this whole space, from my perspective, from what I see, trying to make an educated guess, I think there could be some opportunities for some capital appreciation on those on fixed income. So that's how I feel it. It comes back again, staying true to my playbook, staying true to my investing ideology, and executing it and stay loyal and stay religious to it, I guess. And so that's kind of how I'm dealing with the FOMO now. And dealing with FOMO is really hard. It's a bias that we are all going to be running into. The good news is you can't get rid of it, but you can manage it. You can, if you are aware of these biases that are out there, and it says I teach a course on this, you can better be aware of it. That's number one, is awareness of the biases, and number two, managing the biases, controlling the biases enough in the short term that you can lay a good foundation for some long-term gains and long-term benefits that are going to contribute to allow you to stay on your investing path. And so from my experience, from what I do and how I practice investing and how I do investing, having a playbook and having a really tight investing ideology that you are loyal to and you are consistent through good times and bad times, through good predictions and bad predictions, is a core fundamental, something you really need to have in your tool chest and something you need to have and develop as a skill set. Because as I said, we're not wired for this, to think like this. We're wired to be on the winning team. And unfortunately, sometimes to be long-term successful in investing, you have to take uncomfortable positions. And that might mean being on a losing side for a while. And we have to train our mind to get around that bias that is inherent with us. And it can be done. And it can be done. It just takes practice and it takes engagement and it takes education, understanding the core principles of how markets work, how companies create tangible wealth, how they become more valuable. These are the principles you got to develop, and the foundations really of core successful investing. So I wanted to share with you today, a bit of a build up on top of what we talked about in some previous takes. I think it's really important stuff here, and I think if you're not doing that kind of thing right now, it's definitely worth time to start educating, start engaging, and start training your mind to manage these biases, to manage these feelings. It's what it is. It's feelings of missing out, of not being on the winning team with respect to investing. So that's all I got for you today. If you want some more information about my coaching programs and the investing courses that I teach online and in real time in person, if you live in the Toronto area, I do real time in person sessions. You can find me at sageinvestors.ca. You can also find me, we have a LinkedIn page. Just do a search for Sage Investors. You can find me on Threads. I'm always posting in real time my investing decisions that I make in real time. Hashtag Sage Trades 2024 is the latest iteration. And you can find me there. I'm on Twitter, not Twitter X, whatever the hell it is. I'm really not on there as much now anymore. I'm really now more in the threads kind of vibe right now. I'm on LinkedIn also, and those are kind of my hangout places. I'm not on Facebook as much now. Like I'm not on Facebook because they kicked me out of Facebook because somebody hacked into my thing and like I can't even get into it now. So it's like, okay, fine, whatever. Bye. So I'm not so much on Facebook anymore. But I'm on LinkedIn and definitely through my website is definitely in threads, sageinvestors.ca. So that's it. That's all. It's been another take of In the Loop. My name is Amin Raina again from Sage Investors. We'll catch you again another time. Take care. Bye bye.